The electric vehicle industry has reached a critical inflection point as Tesla reported disappointing fourth-quarter delivery numbers that confirm a broader transformation in both the company and the entire EV market. Tesla delivered 418,227 vehicles in Q4 2025, falling short of analyst expectations of 422,150 units and representing a significant 15.6% decline from the same period in 2024. This marks the company's second consecutive year of contraction, with full-year 2025 deliveries totaling 1.64 million vehicles, an 8.6% drop from 2024's 1.79 million. The implications of these numbers extend far beyond Tesla's individual performance. For the first time since the modern electric vehicle era began, Tesla has lost its title as the world's largest pure electric vehicle manufacturer to Chinese automaker BYD, which reported sales of 2.26 million pure EVs in 2025. This shift represents a seismic change in global automotive leadership and signals the rise of Chinese manufacturers in the clean energy transition. The primary driver behind Tesla's delivery decline was the expiration of the $7,500 federal EV tax credit on September 30, 2025, which created what industry analysts are calling the tax credit cliff. This policy change triggered a massive pull forward of demand into the third quarter of 2025, as consumers rushed to take advantage of the subsidy before it expired. The subsequent cooling of demand in Q4 was predictable, but nonetheless painful for Tesla and the broader EV industry. Tesla's stock reaction to the delivery news was telling. After an initial pre-market surge of 2.5%, driven partly by record-breaking energy storage deployments and a charitable stock donation from CEO Elon Musk, shares quickly retreated as investors digested the reality of declining vehicle sales. By midday, Tesla had slashed its early gains, demonstrating the market's growing concern about the company's core automotive business. The geographic breakdown of Tesla's performance reveals important regional trends. In Europe, the company's struggles were particularly pronounced, with registrations declining 66% year-over-year in France and 71% in Sweden during December. However, Tesla maintained strong performance in Norway, emerging as the top-selling carmaker for the fifth consecutive year with a 19.1% market share. This divergence highlights the importance of local policies and incentives in driving EV adoption. The competitive landscape has fundamentally shifted during this period. BYD's ascension to the top spot reflects the broader success of Chinese manufacturers who have combined aggressive pricing with rapid technological advancement. Chinese EV companies have benefited from substantial government support, lower manufacturing costs, and a massive domestic market that provides economies of scale. This competitive pressure is forcing Tesla and other Western manufacturers to reconsider their strategies. Tesla's response to these challenges involves a dramatic strategic pivot toward artificial intelligence and autonomous driving technology. CEO Elon Musk has spent recent weeks positioning 2026 as Epic 2026, a year that will be defined by the commercialization of the cybercab robotaxi and the launch of the long-awaited affordable Model 2. This shift from hardware manufacturing to AI and robotics represents one of the most ambitious corporate transformations in automotive history. The broader electric vehicle market is experiencing what analysts describe as the end of the early adopter and subsidy-driven era. Consumer interest in pure battery electric vehicles has dropped to just 11% in early 2026, according to recent surveys. High interest rates, with average auto loan rates hovering around 7%, have made big-ticket technology purchases financially challenging for many middle-class households. This economic reality is forcing a reassessment of EV adoption timelines across the industry. The winners in this new environment are increasingly found in the hybrid segment. Companies like Toyota and Ford have seen a surge in demand for plug-in hybrid electric vehicles, which are forecast to grow by 32% in 2026. These vehicles offer a middle ground for consumers who are wary of high interest rates and concerned about charging infrastructure limitations. The hybrid approach provides the environmental benefits of electric drive while addressing range anxiety and charging concerns. Tesla's energy division has emerged as a bright spot amid the automotive challenges. The company deployed a record 14.2 GWh of storage in Q4, demonstrating the growing demand for grid-scale energy storage solutions. This division's growth suggests that Tesla's transformation into a broader energy company may provide revenue diversification as the automotive market becomes increasingly competitive. The regulatory environment is poised to play a crucial role in Tesla's future direction. A high-profile White House press conference in late December 2025 saw Elon Musk alongside President Trump discussing the Department of Government Efficiency and creating a federal regulatory framework for unsupervised autonomous vehicles. This potential regulatory tailwind could accelerate the rollout of Tesla's full self-driving software and the Cybercab, providing new revenue streams beyond traditional vehicle sales. Production challenges remain significant as Tesla attempts to execute its ambitious 2026 roadmap. The company has confirmed that mass production of the $25,000 Model 2, codenamed Project Redwood, has been pushed to the second half of 2026. This delay puts enormous pressure on existing Model 3 and Model Y refresh programs to carry revenue through the first half of the year. The Cybercab production, scheduled to begin at Gigafactory Texas in April 2026, aims for an ambitious 2 million units annually by year-end, requiring successful implementation of Tesla's revolutionary 10-second assembly cycle. The financial implications extend beyond Tesla to the broader EV ecosystem. Pure-play EV startups like Rivian and Lucid continue to operate in what analysts call a survival phase. While Rivian met its revised 2025 guidance, the company continues burning cash as it scales its R2 platform. For smaller players, the loss of federal credits represents a significant hurdle that may force industry consolidation by late 2026. International markets are showing divergent trends that complicate global strategies. While the U.S. market cools and Europe faces economic headwinds, China continues to see rapid EV adoption. This regional divergence is creating challenges for global manufacturers who must balance production and investment across markets with very different growth trajectories and policy environments. The investment community is grappling with how to value Tesla in this new paradigm. Traditional automotive metrics like vehicle delivery numbers are becoming less relevant if Tesla successfully transitions to an AI and robotics company. However, the timeline and execution risks for this transformation remain substantial. Wall Street strategists have begun revising their models to account for potential autonomous driving revenue, but skepticism remains high about Tesla's ability to achieve its ambitious technical and production targets. Looking ahead, 2026 will be a defining year for both Tesla and the broader electric vehicle industry. The success or failure of Tesla's strategic pivot will have implications far beyond one company, potentially influencing how other manufacturers approach the balance between hardware and software revenue. The regulatory environment around autonomous driving will determine whether Tesla can unlock the massive recurring revenue streams that justify its current valuation. The broader economic environment will also play a crucial role. Interest rates, inflation, and consumer confidence will all influence whether the electric vehicle market can recover from its current challenges. The Federal Reserve's monetary policy trajectory remains perhaps the biggest factor determining auto loan accessibility and thus EV adoption rates. Tesla's Q4 delivery miss represents more than just one quarter's disappointment. It marks a fundamental transition in the electric vehicle industry, from rapid growth fueled by subsidies and early adoption to a more mature, competitive market where success will depend on technological differentiation, manufacturing efficiency, and the ability to adapt to changing consumer preferences and economic conditions. Whether Tesla can successfully navigate this transformation while maintaining its position as an innovation leader will determine not just the company's future, but the trajectory of the entire clean transportation revolution.